I think you invest in necessities, in jobs that are needed and jobs that are coming, and in local markets for the people that are going to be coming, provide them great housing. That's what we do, right?
Mhm.
And you're going to do better than the average person that's sitting there going, I don't know where it's going to go, so I'm not going to
Mm.
take any action.
Alrighty, folks, it is election day. It's also 2 days before Fed Day. And we have so much to talk about with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. It's
I
a
don't
great country to live in. Lots of unknowns coming up, but I think we live in the greatest country in the world. So
uh,
that's a blessing.
I agree with that. Today's election day again, folks. This will likely be posted this afternoon, so if you see it, get out and vote. Yeah, the one thing I would hope for, if I could wave a magic wand or get a wish from a genie, is whoever wins tonight, I want it to be clear and concise. I want this thing over tonight, maybe technically 1 or 2 a.m. on the East Coast, right? West Coast, East Coast. I would love this thing. I would love that. What is that phone call that the loser makes? I'd like that to be done tonight, just so we
Yes.
can get over it. No Al Gore, George Bush hanging chads in Florida. I don't want a 40-day contested election.
Yes.
I want clear and concise. Agreed?
100%. 100%. I just hope that there's no questions and riots and any of that kind of stuff. It's clear and over with tomorrow would be great.
Yeah, I agree with that. Well, let's not talk about the election because, again, I don't think that changes my business one iota. I think I do the same thing tomorrow or the next day, regardless of who is selected. So let's talk about the Fed Day. Fed Day, I think the odds are like 99.9% chance that they're going to be cutting a quarter. I assume you are in that camp.
Yes, I am.
Yeah,
I don't
I
see anything earth-shattering one way or another that says inflation's either way higher or recession risk or high GDP is going to be significantly different than it is today or that it has been the last couple of weeks. So I do think that the Fed has recognized that they are in still restrictive territory and that there's dangers of staying in restrictive territory too high for too long. And we still see some softening in the labor market and some revisions downward, as we always do, that says the labor market's not quite as strong as the last headline number. And so I think that that's going to give the Fed enough to cut 25, but the labor softening isn't bad enough. And we're not technically in a recession. The leading indicators are still kind of flat, slightly negative, bifurcated. And so I don't think the Fed has enough to say, we've got to cut another 50. And in fact, if they do cut 50 at this point, I think the markets would go nuts and you'd have the fear gauge go way back up again. So I think they just kind of come in and nonchalantly, we're meeting our goals and we're cutting just to not be, too restrictive, and they go 25.
Yeah, I think the real discussion will once again be the Q&A afterwards. I think he's going to, Powell will be asked, dozen different ways. Where does he think, that number is, right? R star or the neutral rate.
Right.
And I expect him to not answer it because he's never answered it before.
He'll say, we don't know.
Yeah, we don't know. It's we're trying, all those
Mhm.
things. But all the experts that I've listened to over the last, I don't know, week or so peg it somewhere between 3 and 4%. And right now I think we're sitting at 4 3/4. That'll take us to 4.5. So it looks like we have at least 2 more Fed rate cuts. Claudia Sahm, who was on the channel last week, thinks we're actually going to get a series of 4, and then the Fed will be done. How does that feel? How does 4 rate cuts, 100 basis point feel?
I think we need at least that. I think a lot of it will really determine, where labor market conditions go from here, and kind of the breadth of the weakening in the economy. Does it go beyond kind of real estate and manufacturing, which are clearly recessionary now? Do we have more small businesses fail? Do we have more, big layoffs announced? Those kind of things will require rates to come down. And probably more precipitously than what you just said. I've also read and heard different Fed officials say that they thought the neutral rate was somewhere around 2.5%. I've seen that number thrown out multiple times. And so, in an economy, if you think that we're going to have slow GDP that's going to struggle to hit 3 when their inflation target is 2, I tend to think that rate that's kind of neutral is probably closer to that 2.5-3% mark than higher.
Mhm.
But if we get something that really stimulates the economy, and you have tax cuts, let's just say, for example, we have a sweep to the red, to the conservative side, you're going to have tax cuts. What's that going to do? It's going to make the stock market rally. It's going to make people feel wealthier, and they're going to be ready to go spend again. And that could make, all the money that's on the sidelines waiting to invest, they don't want to have that spark inflation again if rates are too low. So then in that situation, the neutral rate might be a little bit higher.
Yeah, it's really interesting. I've been talking about, I think we've both been talking about, just the economy is just, we just hit a big old pause button or an air pocket.
Mm-hmm. Yeah.
The last 10 weeks or so. And we're seeing numbers from like Wynn and Marriott and Yum Brands and all these things showing both the high-end consumers like Wynn Resorts said, hey, the VIPs aren't coming, right? They're not showing up. Marriott saying, customers are price sensitive. That would both be in the bifurcated on the upside.
Yeah.
And then we got Yum Brands, KFC, Pizza Hut, all these others missing same store sales. So it looks like everybody just went on the big old pause button until this election is over. It's what it feels like.
Absolutely. Absolutely. And it's not, super surprising. There's a lot of uncertainty, and we've had 2 years of this uncertainty and, cost of living continuing to go up to some extent, at least on the areas that the Fed doesn't really control, right? The things that are excluded, the food, the energy, the insurance, the healthcare, those kind of things I think are starting to really hit people, and they're getting more weary. And elections, even though, again, I mean, we're not going to do a whole lot differently, but it will impact policies, our taxes, and that's made people nervous. So it's not surprising that they've slowed down. The question is, how long does that slowdown last? Is there any big rally or change, and then is it sustainable after this to see where things might go? But we are America. We are spenders. We do like to go into debt, at every level, from, corporate to government to people. And, typically what we see is eventually people start spending again, and you rarely see like this huge depression. We might not have a recession, even though I've been saying, the conditions are there throughout most of the economy. They're just not there enough to make, to stop things and bring it to a halt. So spending is probably slow at a halt, but I don't think it's going to go away for good.
No, I mean, if you go back and look at, the last, I think 8 or 9 presidential elections, there's generally speaking a rally, at least in the stock market, post-election, post-results, right? Post-results.
Right.
And this just because, and I don't think this time will be any different. There's got to be hundreds of millions of dollars sitting on the sidelines, just waiting. Because again, you're going to, based on if Trump wins or Harris wins, the assets that will do well will be different. And you're going to see some positions changed very quickly based on if she wins or if he wins. So it's interesting. The one thing I am really starting to get comfortable with, and I think I brought this up last week where I was kind of toying with it, but now I'm getting pretty confident. I think both of our recession calls might be wrong, right? Both you and I for 12 to 15 months have been saying, hey, recession around the corner. I'm starting to think this no landing has a real chance. And the issue with a no landing is, you kind of brought it up earlier, rates are going to stay higher. And that's going to hurt small and medium-sized businesses. That's going to hurt
commercial real estate, right?
Yeah.
I'm not immune to this, to the pain. But
it's going to hurt commercial real estate for sure.
I definitely have started to be concerned about that, concerned in some ways and not, less concerned in others. I think, again, when we look at the historic indicators, and this is what's so challenging, not just to you and I, but economists who study this for years, and they've been doing it for years, is when we look at all of our historical indicators, which is the best that we have, to say, where are we headed? What does it look like when we've been here before? What is kind of the thing that follows? Because we want to watch, we want to be prepared for the economy to do things that could impact us as investors. And so I don't think that we miss the mark on being prudent and reading the indicators. Like, I think we've done a really good job of trying to educate investors and figure out, like, historically, if these are the things we're seeing, what does the headline mean? Does the stuff underneath the hood tell us something different? And I think the answer is definitely yes. We definitely have had weakening in the economy. There is no doubt about it. But the challenge has been these historical indicators that have always been, that we've said have been accurate in every recession or very close to every recession. We've seen all of them, Michael, in the last
Oh,
2 years, from the Somme rule, as you mentioned, Claudia Somme, to the McKelvey rule, to the inverted yield curve, to the number of jobs that are created that are government and healthcare versus private sector jobs, like to the amount of debt that households have. I mean, all of these things have indicated recession is here, or it's about to be any moment, imminently. And
Yeah.
so historically, those numbers have told us that yes, it is. And historically, the Fed has rarely had a soft landing when they've gone into an inflation cycle of massively raising rates and cutting it down. So, I've been somewhat of a proponent of Powell. I think he's done the best that he could with the tools that he has. He didn't allow the double recession like Arthur Burns did. Like, he's been successful in meeting a lot of their goals. Whether we think that he's done it all perfectly, of course not. But historically speaking, I think the recession call, that it's coming and on the horizon, there's been a lot of good data to show us that. But what we're seeing is the fact that we do have a very bifurcated economy, and the wealthy are still spending, and the government is still spending, and the everybody that has savings or they've had equities, they continue to make good gains. And so that keeps them spending, even though they're nervous, and maybe some of them doing it on debt. So that bifurcated economy, and I think the amount of money that came into the system post-COVID that went to every area of the economy, there's still a lot of that money sitting out there. And so even though you do have recessionary conditions, there are sectors of the economy that clearly are in recession. I think we got those calls right?
Yeah.
Real estate, manufacturing, part of industrial, like even some of to your point, like when Dollar General goes under, and that tells you that the poor people can't spend money. When people stop shopping at Target and they go to Walmart for their groceries, that tells you like people are struggling. So I do believe we are in a silent recession. We're in a general recessionary type feeling for most households, but that doesn't mean the economy itself as a whole. And recessions are declared on the aggregate. And on the aggregate, the government has spent enough money, given us enough money, that people are still spending, and we're technically not going to have, we may not have 2 quarters of negative GDP.
I'm really starting to dig into this no landing scenario. And the reason this is important is, obviously, we kind of brought it up earlier, is just that rates are going to stay higher for longer.
Yeah.
Right. Whether that's, 30-year mortgage on residential. I mean, it could be 7% all of 2025. Right.
I think it really does depend on what happens with the election. And again, even though I agree with you that you and I are not going to go do anything differently tomorrow, the one thing that I might do differently, if I were in a position where I really needed to sell a property, I will say this: if there's a broad, like a sweep, every, House, the Senate, and the presidency all go to the Democrats, we know our capital gain tax is going to go up a lot. So if anybody was going to make any decision between now and the end of the year, if they were going to sell a property, they probably want to do it right now.
Right.
Take the low capital gain rate, and hope that they don't backdate, which they can, the legislative changes to all of 2024, but that it goes to 2025. So that might be the only thing that I would be like, oh, I have to do this right away, right?
Yeah.
Or you just wait and then you got to do a 1031 and you can't take advantage of the low capital gain rate. So that might be the only thing immediately. But the reality is this: if you have a sweep, again, I'm going to say right now, the sweep to the Democratic side, equities won't do as well, because they're going to worry about corporate tax rate increases, and what that does to the economy. Where tend to be, if the pendulum swings the other way and it's a total sweep to the Republican side, equities are going to rally. And I think that rallying of equities, some calming of the bond market, because they think that the Republicans are less likely to put us in as much debt as the Democrats are, although that remains to be seen whether that's true. Both sides actually have a platform that requires them to spend a lot of money
of spending,
more debt.
both sides.
But the perception is, if you stimulate the economy by giving corporate tax cuts, it will trickle down and the economy will do better. I think if that happens, you are more likely to see a little bit of growth re-stimulating, where if it sweeps to the left, I think there's going to be some fear, some softening of those equities. And that's going to make people even more nervous to spend. And I think that that could put us in further economic weakening and more recessionary territory. Now, again, I don't know. I don't know what's going to happen. So I don't want somebody to say, oh, it's not that I think Republican financial policies are going to save us or Democratic financial policies are going to doom us. Neither really has a great track record or great plan to do the kind of things we need to do to stimulate the economy and to get us out of debt. But those elections will have consequences. We would be foolish to think that they won't, and it won't impact the economy. So I feel like next week we'll have a better insight to what was at least like the gut reaction of the markets and of people. Does it impact people listing properties? Probably not within a week or anything like that. But I think that a lot of what happens in the economy in the next year will be impacted by the policies of whichever party, gets into power, both in Congress and the presidency starting today.
Yeah, I agree with all of that. I'm still really focused on this no landing scenario because I wasn't thinking about it 45 days ago. I wasn't thinking about it 60 days ago, right? 60 days ago, I was talking to a lot of real estate guys, and they were planning for mortgage rates to be about 5.5, right? Sometime in 2025, probably in the first half. Right. This is when rates were 6.1 ish.
Yeah.
And, it made a lot of sense. And then I came back and got quiet and started reading, and I'm like, I don't think so. Right. Yeah. I think there's a chance that, Q4 GDP right now, according to GDP Now, is 2.8%, after Q3 of 2.9. That's not recessionary. Right. You could.
It's not recessionary. It's not strong, but on the other hand, so it's not strong. It doesn't excite me. Number one, because I know that 2.8 will be revised downward because the number, it will be. Michael, I would bet money on it because the GDP number also has extrapolations that are made into that calculation based upon employment numbers, which are coming down. So a lot of people think GDP is just a straight, here's what our sales were. No, there are calculations that assume certain things in order to come up with that number. A lot of people don't know that. And quite frankly, I didn't before until I started really digging into how these numbers come up. So I don't believe the headline numbers. If any of you have listened to me long enough on this show, I think that's clear because we see evidence that they're extrapolated and there's a lot of assumptions made in there that are just not accurate. And most of the revisions are downward. Not all, but most are. So if you have an inflation that is 2 to 2.5%, and you have an economy that's making 2.8%, you really don't have enough to stimulate the economy, especially after taxation. You just don't. And so
it's just going to be
our
that
economy
painful...
needs, right. And so it's not that I'm disagreeing with you that we'll have a no landing. I think the question is what's the definition of no landing? And is that necessarily a good thing, right?
Oh, I know. To be clear, I don't think it's a good thing. I would much rather have a recession. A recession is a cleansing function.
Yes, me too.
What I envision for the next couple of years is 81, 82. It's not fun.
Well, and that's why I keep saying, again, definitions matter, but people will nitpick the nuance of our words, right?
Sure.
We haven't had this exact thing happen before. We have rhymes, and as we know, like you and I, it's been clear that we're in similar situation to part of the 70s that leads into the 80s. And a lot of the same kind of conditions still could lead to some of the same results, although it is different this time in the amount of money that was in the system, right? But the reality is this, we can use these terms. Okay, it could be soft landing. No landing, just basically most people would say that means no recession. Okay.
Agreed.
But no technical recession at a national level doesn't mean no recession. We can use the term rolling recession, which you and I both have, and we've seen that. Sectors have popped in and out of recession, and they're just not there. There's not enough of them all at the same time to be at a national recession. That doesn't mean you don't have a recession. So it's like, did we really have a soft landing? No, manufacturing's in the crapper. Real estate's in the crapper. We're not unscathed, right? People are living 70% of the population living check to check. You could call that a silent recession, right? Again, we don't have a headline. So let's congratulate the Fed and say that they've created this soft landing or no landing and everything's fine. Everything's not fine. So we can use rolling recession. We can use silent recession. I still believe, and I've been saying this for a long time, it's much more akin to stagflation. We
Agreed.
still have sectors of the economy. And again, even though the headline and core numbers are coming down in terms of inflation and trueflation, I have to be honest, I haven't looked at it in the last 2 weeks. I normally look at it every week, but trueflation was ticking down below 2. It might be close to 2. I don't know if you want to look up what that is.
I'm going to look it up. Yep. Go for it.
Great. But it's generally around 2%. So the Fed has gotten close to its 2% target. But when it comes to what people spend the most money on, Michael, it's not those things. It's their food, it's their energy, it's their insurance, it's their taxes, it's their healthcare. And the cost of those things has come up more than the average inflation cost of living adjustment of about 25% over the last couple of years. And so people's wages have not kept up with that. So most people, 70% of people are living under conditions where both growth and inflation have been not in their favor, and they are living like they're in a recession today, regardless of what we call it. And I don't see a lot of things changing that. Again, depending on what happens with policies and elections and taxation and how much money's dumped into the system can change all of it pretty quickly, and make all of us wrong because of artificial money pumping into the system. But I don't believe that when it comes to the things that make up the most amount of cost of living adjustments, that we have a rosy next couple of years and we're just going to have something that changes all of that overnight. So, it's like I'm probably nitpicking semantics. I just want to say a no landing, rolling recession, silent recession, stagflationary type in conditions where growth is very similar to inflation. It's just kind of flat, not significantly coming out of it, is not necessarily better than let's have the recession, have the washout, and let markets do what they should do naturally without more government intervention, whether that's fiscal or monetary policy. I'd rather see and not that I'm calling for more pain for people. That's the next thing they're going to say is, Michael and Anna, you want a recession, you want more pain for people. Like, they're already in the pain. Let's just declare it and get it over with, right? Yeah.
So trueflation, not good news, is up to 2.62, highest it's been in quite a while. It was as low as 1% back in, let's call it late September. Now back up to 2.62. So
let's just play a game, Michael. Let's say that it stays at 2.62 and growth is at 2.8 pre-tax.
Yeah.
What does that mean? What would that make the next 2 years look like?
Well, when I think about this, I come up with a couple of things. The first domino is rates are higher. They just have to be.
Yes.
Rates being higher hurts kind of everybody but the big guys, right? Small and medium business hurt. Starting a business hurts. Car sales hurt. Real estate sales hurt. Anything that's based on debt hurts. Second, and this is what
does that then lead to a recession and lower rates after 2 years?
In 2 years, probably. Because so I'll paint the whole picture because this is really bugging me now.
Yeah, me too.
Because the higher the rates are, it's just like 1,000 paper cuts. No individual paper cut is deadly, but eventually they all add up.
So 1,000 cuts.
Exactly. So you have higher rates that hurt all the small and medium sized business. Anything that's debt based hurts consumers. Yada yada yada. Next thing that happens is layoffs. Unemployment rate doesn't have to spike crazy, but this is what I really fear is if you do get laid off, like my father was laid off in 81 or 82, whenever that was, you might be laid off 11 months before you can find a job.
Yeah. We're seeing that in certain industries for sure.
Yeah. Yeah. So again, I don't like the unemployment rate may stay below 5%, may stay below 5.2. But if we have a duration problem where the unemployment, tenure or whatever they call that goes from 60 days to 300 days, that's a problem for lots of families.
Right.
So that's the next thing. Cause I don't think the unemployment rate will go bananas. but I do
Right.
think duration. I think
Especially
duration.
because we've added 6 million immigrants to the job force. And that's not a political statement.
No,
It's, whether you think we should have or not, right? We have 6 million
they're
more
here.
people working.
They're here.
And so that does change. It's another one of those things that, yes, history rhymes, but there's new things that can make those numbers not mean the same thing today as they
Yeah.
did, 2 years ago, 5 years ago, 30, 50 years ago.
Yeah. So the next thing that happens is the extend and pretend in the Class B and Class C commercial real estate market really gets hammered. Class A is trading, right? Ken McElroy just picked up a property a couple of
Yep.
miles from me for
Mhm.
25% off. So Class A is already trading. Class B and Class C are still stuck in la la land. There's nothing
Absolutely. Well,
trading.
more will default, and
Oh
then
yeah, clearly.
the banks that hold them will as well.
That's the next thing, right? We're already
Mhm.
if Class A is discounted 25%, Class B and Class C are going 40.
Yeah,
They
they
just
already are.
yeah.
They already are in a lot of areas of the country. Yeah.
So you go 40, all the equity's gone. Banks are impaired at least somewhat because the loans were probably 70%, 75% LTV, maybe 65, but still they're
Mhm.
going to have a haircut. And then we get commercial banks problems.
Yeah.
That's the next. I mean, this could be a very like to me it could feel like you're going through mud. You're still making some progress forward, but it's not fun. It's
Right.
slow. It feels heavy. It takes lots of effort.
Right.
And
And your mileage may vary. I think
oh,
that's kind of like back to that rolling recession idea, something similar to that is that depending on what sector you're working in, what sector you're investing in, what area of the country and how that local GDP is, what's driving the growth for those areas, your mileage may vary significantly. There may be people that do extremely well, and there may be people that really, really struggle. And so,
that
it's just
exactly.
this, how much longer is it hurting, 50, 70% of the population? How much longer can they live check to check
Oh,
before things get worse, or before anything that happens that's unexpected kind of is that last hammer that kind of knocks down all the dominoes? And I don't know. I mean, I'm hoping that that's not the case. I mean, I think you and I both, like, we want the best for the American people and the
of
American
course.
economy, right? None of us want more pain. But I
No.
think the reality, what I struggle with, trying to figure it out, right?
Mhm.
What I do know is that the older I get and the more I go through, the more humility we have and our wisdom to say, like, we don't have it all figured out, because all of these things are so different, and things this time aren't following the exact pattern, and there's more that could happen. Like, we're all trying to guess, we're all trying to hedge, we're all trying to protect ourselves and our investors and our students, and talk about, like, what could happen, how can we prepare for that just in case, put ourselves in a really good position. But we all still want to hope for the best, and we all want to move the needle and act with confidence that we can still control our personal economy as much as it is up to us. Like,
Mhm.
we try to figure it out, but let's take action to put ourselves in the best situation. So what I kind of struggle with to figure out, right, is at what point does the bifurcated economy tip the scales one way or the other? Is the fact that there are certain sectors of the economy that are really struggling? Is there anything that's going to make what's the thing that's going to spark the regrowth of those things? Manufacturing and real estate. Let's just talk about that, because they're usually the first two things that go recessionary, and then they're also the first two things that lead us out. And I think
Sure.
that's really important. I don't hear anybody talking about that, Michael, but not only have we gotten into recessionary tough conditions in those industries, and the reason that usually leads to a recession is because there's so many trickle down jobs that are created by
Mhm.
those sectors. So if real estate slows, so does construction, so does house renovations, etc.
Mhm.
Landscapers, people that start DIYing because they can't afford to hire, all the people to do their projects. They halt on projects. They can't get the lending. Then you've got manufacturing. So those things trickle down. What usually happens to get us out of a recession is those sectors respark, right?
Mhm.
Historically, we're not, if we don't have a cut in interest rates, in these long-term rates, it's going to be very hard for real estate to rally. It's going to be very hard for construction and manufacturing to rally. So then the question is, at what point does that put us into a deeper recession that's worse for everybody? I don't know. And
Yeah, it could be 2 years. It could be 2 years. And that's when I look at the dominoes and I kind of play the worst case scenario. Like these paper cuts, it's to me, it's so much like the 80s and the savings and loan crisis.
Yeah,
people think about the S&L crisis was like a 6-month or an 18-month thing. It was like 9 years.
Yeah.
Years.
And that's why, like, I want to be an optimist. I am an optimist. Like, if I didn't look at the future as better than the past, or optimistic that I could control my personal economy and make better decisions for my family to put me ahead regardless of what happens, I never would have ended up where I am today. So I'm a super optimist, but I also count the cost of everything that I do. There's like a scripture somewhere that's like, who builds a tower without counting the cost? Like, or, you've got to figure out if you have, without counting the cost, and if you have what it takes to build it. Right. So it's like, we have to look at these things, and I want to be optimistic, but I just don't see, and I hope I'm wrong, anything that's really going to be like our next industrial revolution, right? Maybe it's not manufacturing and housing. Maybe it is tech and healthcare, which is what everybody's helping for. But how much of the economy can really be stimulated quickly in the next 2 years by tech and healthcare? I mean, it's certainly been good for equities if you own stocks in those sectors, but it hasn't necessarily been productive, producing GDP and getting the whole economy rising. Where is that going to come from? And how quickly is that going to be? I just don't see it happening quickly. I think we have to prepare ourselves for a little more of the same, still some pain, and then go for it and do what you can to move the needle for yourself, hoping for the best.
Yeah, I agree with all of that, and both of us are generally optimistic, but we've got to look at what's ahead of us, because we can pivot, right? We have the options to pivot. One of the things that I do see is that will be very different, I think, in 4 or 5 years than it is today. Is I just have this crazy belief that we're gonna, like, Gen Z is gonna over rotate to the trades, right? There was a Gen X where I roll. It was very much go to college, get a good job, be white collar, poo-poo the blue collar. I think one of the things that's coming out because of AI is going to see a lot of white collar jobs go bye-bye, or at least significantly, changed. And I think we're going to have a lot more blue collar, the trades. And frankly, that's a good thing.
I agree.
Right? So, that, again, that doesn't happen overnight. It happens one person at a time. I think Wall Street Journal a couple of weeks ago put out an article about, the new millionaires, the person starting in, in air conditioning or painting or, basically blue collar work. So, I think that's one of the things that, well, again, it's not going to be fast. The next couple of years could really suck. But, the other side of this is it's frankly could be a more balanced economy. You turn some white collar into blue collar. You also bring back some manufacturing, right? Pharmaceuticals or other, in things that are important to us that, our enemies shouldn't be making for us.
Yes.
The economy could be far more stable and balanced in 2 to 4 years. It's still 2 to 4 years from now.
Well, and I think that's the thing. Like, I do believe, and thankfully both parties, major parties, Republican and Democrat, are pretty well on the same page when you look at the laws that they're passing and the things that they want to pass in terms of reshoring and some deglobalization as a matter of both national security and financial security. And so definitely, we've already made some progress. We had the Build Back Better plan, whether you liked it or not, right? How it's paid for, whether you like the taxation or not, et cetera. But the reality is both parties are pretty well in agreement that they need to bring back certain parts of manufacturing, semiconductors, making parts for our drugs here. When I don't remember the stat, Michael, but I think it was like 70 or 80% of the components needed to make our drugs are imported from China. Yeah. That was like a huge shock to me that it was that high. So it's like, if we start bringing in some of these things, and we do start putting money into infrastructure, that kind of talks to those blue collar jobs, the construction workers, the road workers. If we start putting money into affordable housing, that is going to definitely bring some stimulation into the blue collar and the manufacturing world again, where we didn't have it. But it's going to take several years for that to really start yielding the productivity growth that we need to kind of get us out of a stagnating or high inflation environment. So you have to make the investment, and I think our country is going to do that. So I'm still bullish on America over the long term. It's just that those things generally, I mean, anything that's run by the government, Michael, I think we all know, no matter who you vote for, like it's inefficient and it takes more time than it should. And more money than probably it should. If we want to just say that, and that's true historically, no matter who's in office, that's just the reality. There's more red tape. It just takes time. And so I think, to this point, like we could have a really strong economy in 10 years from now. But what's going to happen between now and then, we don't know. But you've got to watch for it. And I think the whole point of like us talking about this isn't, did we get the recession call right or wrong? Like clearly we've said the right things. These are the things to look out for. But it's how do we take that, and then how do we take meaningful action based upon what we're seeing? And if things change, and it could be that tomorrow, like all of that goes out the door.
It could.
Like, we don't know. I mean, wars can do that to countries. They stop everything other than the war effort. I'm not asking for war. I'm praying that we never have it again in our lifetime. I have kids that are fighting age. Like, I am not a pro-war person. But the reality is, outside of the United States, there's a lot of threats, wars and rumors of wars, right? And so something like that, any other kind of, major national crisis, another, God forbid, another major pandemic, like anything can happen. And so I think, the lessons in all of this is we've got to think clearly. We've got to process what could happen. And then we have to then take action. So let's assume those things don't happen, the worst case things that we're not anticipating. What are the things that are most likely going to generate money for the economy, which then most likely will help us as investors generate money for our families and protect the money we have? And if you can invest in things that the nation needs and that the government is spending money on, that's going to prop up those sectors of the things the government thinks the nation needs, whether you agree with those policies or not. Where is the government spending money? Where do people spend money? Where are we going to collectively put money? Because where money goes, profits rise. Where money goes away from those sectors and those things, profits go down. So if anything, I'm looking at all of this saying, okay, let's see where policies go. Let's see where the government's going to put money. Let's see where people prioritize necessities over wants, because those areas of the economy and the local markets that take on those jobs, take on those things, provide opportunities for people, that's where you have the best opportunity to continue to grow and preserve your wealth and to make great income. And so none of that change, none of the things we're seeing changes that overall paradigm for me. And so, I think you invest in necessities, in jobs that are needed and jobs that are coming, and in local markets for the people that are going to be coming, provide them great housing. That's what we do, right? And you're going to do better than the average person that's sitting there going, I don't know where it's going to go, so I'm not going to take any action. Like,
yeah. One of the things because that's where I'm looking at is regardless of who gets in office, one of the things that both candidates were really talking about and is a problem is entry-level housing.
For sure.
Right. Entry-level housing has been kind of the missing link. The housing market's broken, the bifurcated economy. So you're building luxury stuff. We've got to figure out how to build entry-level housing again. And, hopefully that is something. And again, let's be clear. I'm talking supply. I don't want free money flying around creating more demand. I want supply. So,
yeah, but it is going to, both of those things will require the government to incentivize, just like they incentive, why do we have so many tax incentives to invest in real estate, to create businesses? It's because that's where people create GDP to keep the economy humming. And so there's always going to be tax incentives. What typically happens is the incentives go to a different group of people depending on which party's in office, but the incentives are always there. I think the challenge with real estate and affordable housing is especially as insurance costs go up and as we see, a lot more flooding and hurricanes and all these kind of things, and the cost and insurance companies going out of business and going bankrupt. You can't even get insurance. But as that type of thing happens and costs go up, I don't think the cost to construct is going to come down, regardless of inflation, stabilizes and it's just going up 2% or whatever. Like, we have to figure out a way you can build smaller homes, but unless you have incentives for the developers to be able to make a profit, not even a crazy profit, but a profit, or for landlords to make a profit. For example, Michael, a lot of people don't realize, but the average landlord in the United States, whether you own a single family home or it's a large apartment complex, the profit is only about 8 to 9 cents on every dollar, right?
Mm-hmm.
So if I collect $100,000 in rents, I'm making $8,000 or $9,000 a year, right? That's the reality. That's the average statistic. And some of us obviously do better as we get better and more efficient or whatever. But the government has to provide tax incentives or low interest rates, or give you cash to incentivize you to go build that affordable housing and still make at least 8 or 9 cents on the dollar. So there has to be a lot of stimulus to come out to re-spark the ability for the developers or the people that are rehabbing property to be able to afford to build. And they've got to have lower interest rates to do it without a significant amount of stimulus. Yeah. So I'm not, even though I agree with you that, interest rates may be higher for longer, they may have to come down in order to stimulate again, even if we don't have a recession. And for the government to continue to afford to pay down its debt, it can't afford to do it at these higher interest rates. So maybe the housing, combined with the government's inability to make debt payments if our interest rates are higher, will allow them or require them or push them, whatever you want to say, to cut interest rates, Michael, even without saying we're doing it because there's a recession.
Well, so, we talked about it earlier. I think it's pretty clear there will be somewhere between 4 and 8 rate cuts coming, and those will be coming with or without a recession. I think a recession probably makes 8 to 12 rate cuts, right? Yeah. A no landing in my scenario certainly brings 4, probably 6. Yeah. Somewhere in there. But again, that doesn't mean the 10-year gets cheaper.
Well, right. And that's why that would help the government, and it would help developers and commercial real estate investors, right? Because their rates are based on those lower short-term interest rates, like correct. SOFR, a spread above that. But that doesn't mean that the treasury market, especially if it continues to be concerned with debt and all those other things we talked about, that the treasury market, just like we saw the Fed cut 50 rates and mortgage rates went up a lot, more than 50 bips, right?
No, they're up to 100. They're up 100.
I thought they were almost 100. So, it just shows you how disconnected and how ineffective Fed rate cuts really are when there's other issues in terms of the long-term interest rates. But it does help developers because their really construction loans are generally only 2-year loans. So if they can get in tax incentives, government incentives, and a low interest rate, and they can still get a high enough LTV on building, they'll continue to build, and we could fix the affordable housing issue. That doesn't mean that the homeowner buying that house is going to get that really great interest rate. They might still have a high interest rate that still makes it fairly unaffordable for people. So I hope that we can have leaders that can rise up and fix the affordable housing issue. I really do. I'd love to be a part of that solution in some way, just in providing housing. And that's the beauty of, what we do, is we do provide housing for people. There's got to be people coming together to figure that out. So I'm hopeful that we come up with some really good policies that help us to fix that, regardless of whether the economy is really growing significantly or not.
Well, this has been a lot of fun. It is election day, folks. If you want to follow Anna Kelly, go to AnnaKellyInvesting.com. Closing thoughts.
Everybody go vote. We have a right and a privilege to vote. I think sitting on the sidelines just allows more policies to go into place that are not in alignment with who you are. My grandfather fought in Iwo Jima. Kudos to him. My other grandfather fought as well in World War II and lost family members who died for our freedoms. And I just think that it's really important for us as citizens to go out and vote and use your vote for whatever you believe is going to move, the needle and make our nation better and stronger. So
there you go. Go vote, folks. Go vote. Thanks, Anna.
Thanks.